Stocks falling just short of notching a third day of gains after climbing into the green late in the day. All three major indices closed out negative. And no matter which way markets go from here, our next guest says there is one group you may want to avoid. Let's go off the charts with Chris Verrone of Strategas, a Baird company. So, Chris, what are you watching?
Hey, Melissa. Yeah, thanks for having me. I think when you look at these last, 1-2 days and you have a 5% rally, you have to ask yourself the question, has anything changed? And as far as I'm concerned, what has not changed is the leadership. So we brought along a couple charts to kind of walk you through just that. The first, I think, is really compelling. This is triple Qs, so the top of the market versus the equally weighted S&P 500. And what's so telling to us is last week, when the market was down 4%, triple Qs underperformed. This week, with the market up 4.5%, what has also happened? Triple Qs have underperformed. So the top of the tape, these big tech growth stocks, we just don't think are your leadership, irrespective of whether the next 200 S&P points is up or down. And I think what we want to do is look at some of the big weights here for clues. So let's take a look at Microsoft. Right, this name broke before the S&P broke in mid-September. We've bounced the last several days, but really, has anything changed below 260, 265? I don't think so. I think that's going to be big resistance going forward. Same thing with Alphabet. It's bounced here the last couple of days. A lot of resistance in the 110 to 112 range. I think that's where you want to fade it. There are 51 analysts who cover the stock. 48 of them still have buys on it. That's for a stock that's down 40+% since it peaked. And we look at this also through a few what I would call bespoke relationships. One of them being discretionary versus energy. Right? If something's changing, wouldn't we see a change in that relationship? Even this week, discretionary has continued to underperform energy. Another one of those bespoke charts that we look at is tech versus energy. That has also rolled back over here. So, we've had an up market, we've had a down market, but what hasn't changed is discretionary and tech, and the triple Qs don't outperform the equal weight S&P, and they don't outperform the energy sector. So we just finished with one last exhibit. I think the anecdotal would say that energy's overbought or overowned here, but we don't see it. It's still only 4.5% of the S&P. And when you look at it over any interval, energy outperformed over the last 3 days, last 5 days, last 10 days, last 3 months, last 6 months, last 1 year, last 2 years. Energy is still very much your leadership here. I think the breadth of the sector is fantastic. We're sticking with that long. It's not tech. It's not discretionary. The leadership is unchanged here.
What's the context to this energy call, Chris, in terms of the direction of the overall market?
Well, I think what's been telling all year, right, we've had 2 or 3 really good bear market rallies, and we've obviously had a series of lower lows, and energy's maintained its leadership standing throughout all of it. And I keep thinking about where is the risk here? I think it's still at the top of the market. Energy's 4.5% of the S&P. Apple's 7.5% of the S&P. Microsoft is 6%, right? So you're still talking about a sector that is 1/2 of an Apple. If you look at the flows over the last couple months, even as energy has continued to work, you have seen an exodus from XLE flow. So for us to say it's overowned or overbought, it's not showing up in the charts.
Chris, Bonawyn here. Pleasure to have you. So continuing on that topic of market leadership, we're talking about leadership in the energy sector, and you're looking at Chevron or Exxon. They trade at like 9 or 10 times forward multiples, and we're talking about lagging subsector in technology, which is trading, depending on the name, I don't know, mid-20s. How should we be thinking about forward multiples for the overall S&P as people are coming now saying, this might be a great time to start buying? Do we need to rethink our mental framework around what is the right price for the market overall going forward?
Yeah, it's a great question. And my partners, Jason Turner and Nick Bonsack, have done some really good work on looking at what multiple tranches you would expect given where inflation is. So even if we kind of settle into an area where over the next 12 months, where let's say CPI settles back down to the 3 to 5% range, you're still talking about a forward multiple on the S&P that historically would be somewhere in the 14, 15, 16 range, not the 18, 19, 20 range. And I think with respect to growth stocks and tech in particular, you really don't want to own them when their multiples are in the middle of the range. You actually want to own them when they're very, very expensive, right? You want to own growth stocks with PEs of NA, not of some middle of the range value. So I think it's a very important question. I'm not sure we're going to get the multiple relief that we might expect in the year ahead.
Chris, thank you. Good to see you. Chris
Thank you.
Verrone of Strategas. Courtney, what do you say? Energy? I mean, that graphic was very telling. For any period that you lay out, energy is a top performing sector.
Yeah, I mean, recently it has been, and I don't think that will last forever, but I do think over the short term, I actually completely agree there, and I think you want to continue to have your energy exposure right now. And I do actually like this idea, which I've been talking about recently, where tech is not what you want to be overexposed to. You definitely want to own it. I mean, your Apples and your Googles, they're not going anywhere, but I don't think it's something you want to be overweighting right now, because you do look at those multiples and they're still pretty expensive right now. And even if inflation starts to moderate and we see interest rates come down, it's still likely to be higher than it was over the last couple of years. So your more expensive, longer duration assets are likely going to underperform. And things like energy, I think, are going to still be positioned to do well.
Alphabet guy, Chris said 110-ish land. You want to fade this one. You agree?
Listen, Chris Verrone, I got to tell you something. His work has been extraordinary over the last couple of years.
Say? He's in the pantheon of technical analysts.
Parthenon, Pantheon. I don't know what the difference is, but he's somewhere, right? So, yeah, I think on this tape, given this, Google's been an underperformer. It really has not performed well at all. So who's to say it can't trade to those levels? But I have to just mention something, because our crack staff back in EC, I mean, what do they call those things on the lower thirds of the screen, Mel? Help me out for a second.
The decos, the lower thirds.
Yeah, the lower thirds.
Coup de tech.
Coup de tech. I mean,
Can we put
seriously,
that up again, please?
That's so good. So
Is
good.
it?
So good.
I was wondering if it's really good or really bad, because I think it could really go either way. Oh, it's so good. It's so bad that it's good. Okay, Steve, what do you have to say?
Yeah, so before we get really excited about energy, ExxonMobil, let's take that one out because everyone keeps talking about this large integrated name. It's up 62% year to date. It just got back to the level it was at in 2014. So energy did nothing for years upon years, approaching a decade basically, did nothing. And now, do you take your chips off the table or think you're going to have another outperformance? I say take your chips off the table.
Wait, but I'm no technician, and I didn't say at a Holiday Inn either. But, I mean, the theory in technical analysis land is that the longer the base, the higher in space. And so if it did nothing, to quote the great Louise Yamada, who is also in the Parthenon or Pantheon. Okay, go ahead, Steve.
I stated that wrong. It did nothing would mean that it went sideways. It collapsed for the last for 8 years prior to this. So it wasn't as if it was just building a base. I would agree with you 100%. You and Louise are 100% right about building that base. It didn't build a base. It did nothing. It had headwinds galore at its face. And now it's started to lift its head, or I shouldn't say that. It lifted its head aggressively off the pandemic low. I get why everyone's excited. And everything that Chris talked about was performance on a relative basis. And yes, on an absolute basis this year. I would say just take your profit and laugh all the way to the bank and invest it somewhere else.
The only thing that I would add to that is I think what's different than it was in the 2014, 2015 era is your energy companies are so much more efficient now than they were back then. And they were forced to be that way. But I think it just puts it in a different scenario now than it would be. And I think that's why it might still look attractive here.